Hi everyone, welcome back to part 2 of this lecture on capital market research. I hope you've watched the first part of this lecture, but what I'll do is again I'll sort of recap some of the main points from the first part of this lecture. So remember, the purpose of capital market research is to find out whether accounting information is useful. And what we do is to look at the correlation between accounting earnings as shown in the financial statements with changes in share prices. So remember, we compared capital market research with behavioral accounting research, and the main difference between the two is capital market research looks at aggregate data and focuses on shareholders and the share market, whereas behavioral accounting research is more at an individual level, and it looks at a wider use of accounting information. We'll look at behavioral accounting research later. And remember, the fundamental assumption that we use in capital market research is the semi-strong form of the efficient market hypothesis, which says that share prices will react or will be impacted by information that are released publicly, and the impact of this information will be instantaneous and very fast. Then the next thing that we talked about in capital market research is that we look at firm-specific earnings and the impact of firm-specific earnings on changes in share price that relates to firm-specific specific factors. So we're actually looking at non-systematic risks. And how we do that is that we look at abnormal earnings and compare it with abnormal returns on the share price in the change in share price. So in other words, we look at the correlation between earnings that are not anticipated, so the additional excess earnings that is not anticipated, and compare it with changes in share price that is as a result of these unexpected earnings. So we're looking at abnormal returns on share prices. Okay, right. So that was what we discussed in the part 1 of this lecture. So what we want to go and do now in this video, this part 2 of this lecture video, is to look at various studies that have used these capital market research theories and try to look at various aspects of whether accounting information is relevant or not based on the changes in share price. First, we'll look at one of the most commonly cited and the oldest important research in capital market research, and that's the paper or the study done by Ball and Brown way back in 1968. So we're going to do that, and then we're going to cover several other examples. Okay, Ball and Brown, as I said, did their study way back in 1968. They actually examined data from 261 US firms. What they tested was the correlation or the relationship between these 261 US firms' unexpected changes or increases in accounting earnings, and compared it with the changes in share price as a result of these or changes in earnings. So what they were looking at was they were looking at correlation between unexpected increases in accounting earnings and whether these have positive abnormal returns. In other words, when companies report higher than expected profits, did the share price increase higher than expectation? And vice versa, whether firms that report unexpected drops in profits would cause their share price to actually decline beyond what is expected. So that was what they had tested way back in 1968. Now I'll jump to the next slide where this graph shows the results of their studies. This is not in your lecture slide, but it's in your textbook, so please refer to your textbook. And if you look at the graph, what the graph shows here is on the horizontal axis, if you see numbers starting from -12 to 0, and then +2, +4, +6. Now what that means is that those numbers are number of months. When you see 0, it means the time when the firms report their earnings in the annual report. That means when the earnings results were announced to the public through the release of annual reports to the public. And therefore the negative numbers means how many months before the release of that result. So if you see -2, that means it's 2 months before, -4 is 4 months before, and then -12 is 1 year before. So +2 means that it's 2 months after the announcement of the results, and +4 is 4 months, and +6 is 6 months after the release of the results. And on the vertical axis, you will see abnormal performance index, which is basically the ratio of the change in abnormal returns on the share price. That means the percentage change in the increases in unexpected changes in share price. So the graph that you see going up, that shows increases in share price. So these are abnormal increases in share price. And the graph that is sloping downwards shows the abnormal decreases in share price. So when you see GN means that on the day of release of the results, you have released unexpected increases in earnings, which basically means good news. And if you see BN, basically it means bad news, in a sense that these are unexpected decreases in earnings. So this is the trend of what Ball and Brown noticed when they studied the 261 companies. So if you look at this graph, what this graph is showing is that yes, on the day of the release of the results at time 0, there were changes in the share prices, abnormal changes in the share prices, in response, the correct response to the increases or decreases in earnings. In other words, there was increases in share price as a result of increases in earnings, and there were decreases in share price as a result of decline in earnings. But what you also see is that let's look at the increase, the increase as a result of good news, as a result of unexpected increase in profits. You will see that the slope already starts to move upwards 12 months before the announcement of the results. And if you look down at the graph that shows the response to bad news or unexpected decreases in earnings, resulting in decreases in share price, you note that the share price have already started to decline 12 months before the release of the accounting information. So what is the summary? What is the conclusion from all this? The conclusion is that while, yes, we can say accounting earnings does affect share prices and therefore is relevant, but the market is already getting the same information 12 months before from other sources. So that's what Ball and Brown, those are the important findings of Ball and Brown. So if you go back to the third bullet point here, what Ball and Brown concluded was that information contained in the annual report were useful to the investors. However, 85 to 90% of the earnings announcement were already anticipated by the investors 12 months before that. So the conclusion is much of the information that investors need can be obtained from other sources other than the announcement of earnings in the annual report. Therefore, other information, analyst report, media releases, and all that are considered sometimes more important than the annual report because they are released more timely, they are released more quickly. All right, so they are quick. If you're looking at a semi-strong form market, then these information that are released much earlier are starting to impound or be impacting the share price months before the release of the annual report. Another interesting thing that Ball and Brown noted as well subsequently in their studies was that information content means the relevance of information to and how it impacted share prices actually varies between country and one country and another country, and also varies between different companies. So what they noted was that, for example, compared to the U.S. markets, the Australian market had a shorter time frame. There was a slower adjustment during the year. So what if you go back to the graph earlier, the slope of the incline, or if you're looking at the increases in share price, if you look back at this graph, so if you look back at the top one where you're looking at increases in share price, so what you'll probably be seeing is that if you look at Australia, 12 months before, there's a slight increase, but the slope is rather flat. Okay, and then when on the day you release the result, then there is a steep increase in share price. The explanation for this is that if you look at a smaller market like Australia compared to the US, the availability of other information is rather limited. So a lot of people focus on the annual report. So the bigger the market, the more efficient the market is, people rely on other sources of information. Okay, so this means that in different countries where you have perhaps a smaller market, accounting information become more relevant. Then they also looked at how the information content between large companies and small companies. What they found was that because for large companies, there are a lot more people following the development of that company, and therefore a lot more information that is available for these companies. The importance of annual reports is less. But when you look at smaller firms or even private firms, Sendirian Berhad firms, the only sources of information could be from the annual report. So the impact of the annual report becomes greater. So this is quite interesting to see the importance of information contained in the annual report. So the Ball and Brown study is one of the major studies in capital market research, and as far as you're concerned, you should be taking a closer look of Ball and Brown study and try and understand its main findings. What we're going to do now is cover some of the other results from some of the various capital market research studies done over the years. These are not so important, but so I'll go through them pretty quickly to summarize some of the major issues. In one of the later studies in capital market research, the research examined the relationship between the magnitude of unexpected changes in earnings and the magnitude of abnormal returns. These studies actually look at how big of a change in unexpected earnings would would it take to cause a change in the abnormal return on share price? This relationship is called earnings response coefficient. And what they found was that in general, a 1% unexpected change in earnings is associated with only about 0.1 to 0.15% of abnormal returns in share price. This means that not all of the unexpected changes in earnings or profits would result in a change in share price. So why is it like that? And what is the difference? What are the differences? The conclusion from some of these studies was that the shareholders were able to distinguish in the unexpected changes in earnings between what were permanent changes or permanent increases, for example, in profits, or those increases in profits that were temporary. So they were able to distinguish the two, and they placed more importance on the changes that were permanent, that were more indicative of what was going to be increases in profits in the future. So temporary increases were deemed to be not so important, and therefore does not result in significant increases in share price. Some of these temporary increases could be profits from a sale of a major asset of a particular company that they will do once in a while, or gains from restructuring, or gains from fluctuation in exchange rates that was not expected to be repeated over the coming years. So this is one of the results of the studies relating to earnings response coefficients. The other studies also looked at whether when you look at increases in earnings, whether there is any difference between whether the increases were as a result of increases in cash or just increases in accrual profits. Okay, and of course, what's the difference is that when you look at accrual profits, it includes non-cash items such as depreciation or provision for doubtful debts and things like that. So these sort of studies sort of explored, is there any difference? Will the shareholders distinguish between accrual profits or cash profits? So what they found was that share prices the fluctuation in share prices didn't really focus on, or wasn't really impacted by whether these were cash profits or accrual profits, or how much of the profits was attributable to cash, how much of the profits were merely non-cash items. The next group of results involve studies done on information announcements of other firms. This sort of studies are called information transfers, and what it does is studies the question of whether announcements, earnings announcements by one firm could have an impact on the abnormal returns of other firms within the same industry. The argument that there could be this correlation or relationships are based on the assumption that the conditions that affect one firm could be reflection of what is happening in the entire industry. So if something is happening in the industry that has affected one firm, it should also have an impact on other firms within these industries. So some of these research have found that the announcement of results of one firm, be it good or bad, would have and some sort of relationship or some sort of impact to other firms within that industry as well. So these are called information transfer. The other group of results is whether the information content that was relevant was actually actual earnings, or could it be also forecast earnings? Because in some markets, especially in America, um, the profit forecasts, the earnings forecasts, are very much followed by investors, by stockbrokers, by analysts. And market price are often very sensitive towards profit forecast, okay, or forecast of earnings, and does not really that does not necessarily only look at actual earnings. So this is an example of such a case that was reported in 2013, where the share price of Sony, for example, had reacted to a drop in forecast earnings for that particular year. So there was some evidence to suggest that share prices were sensitive to earnings forecasts, not necessarily actual earnings. Another group of studies look at whether voluntary disclosures, for example, in relation to some of the relevant information, it could be with regards to what the directors were doing, regards to even CSR or social environmental issues. Did it have an impact on share price? And what was found interestingly was that there was some correlation between some of these voluntary disclosures because especially where we're talking about large companies where there were a lot of analysts and potential investors, they were paying attention to these companies. So these companies' voluntary information was very, very much observed because this voluntary information would reduce information asymmetry, and as a result could actually reduce cost of capital because people think that, well, this company is very transparent and they trust this company. Okay, so therefore it has some sort of correlation with market prices as well. Another interesting group of studies were looking at whether accounting information or specific accounting items, does it matter if it was recognized in the financial statements? Would it give more does it have more impact on the share price, or would the share price also be impacted if you merely disclose it in the notes? And I hope you understand the difference between the two. Recognizing an item means that you debit an account and you credit another account, whereas mere disclosure in the footnotes merely doesn't mean that you recognize it, and it may not have any impact on your profits as well. So the question with these sort of studies were, does it really matter in terms of whether a company recognizes an item or transaction in their financial statements, or merely just report it as a note to the financial statements? And the results show that there was some evidence to suggest that investors placed greater importance on items that are recognized. If you merely disclose them, it doesn't have much impact to the share price. This next group of studies, I think we've talked about it, where we said that if you have a very large firm, then because a large firm, there were more people focusing on the share performance and the company's performance, and there were many other sources of information being released about those large companies. The accounting earnings that may not play such an important impact may not have such an important impact on share prices. But if you are a smaller firm and there's not much information outside in the market on your firm, then when you release your accounting earnings results in your financial statements, it will have a greater impact on the share prices of the firm. So therefore, the relationship between earnings announcement and share price movements is inversely related to the size of the entity. The larger the entity, the less the relationship between earnings announcement and share prices. So this whole idea that when firm sizes increase, the likelihood of impact of accounting earnings on changes in share price is lesser because of the fact that share prices incorporate a wider a wider source of information. Suggests that share prices could actually anticipate future earnings announcements. This is to say that when there's a change in share price, especially for large companies, because it reflects a lot of information already available in the market, and if the market or if these information shows that the company is in the right track, is going to make a lot of money, a lot of profits, it's now impounded in the share price. The share price goes up, and then this increase in share price would be proven to be true if all these information are to be trusted in the increase in accounting profits. So therefore, we can say that share price could probably anticipate future earnings, show an expectation that future earnings would either increase or decrease depending on whether the share price goes up or down. So that's an interesting idea that it's not always the case that accounting earnings will impact share price. There is this argument that maybe share price could impact accounting earnings as well, especially in the case of a large company. This slide basically talks about the same things and perhaps looks specifically at whether the market values of a particular firm would have some sort of correlation with the book values. And there is this argument that there is some correlation, and this correlation would then provide stronger argument that market values or market prices would be impacted by accounting earnings. These few studies were also talking about the same thing. This study by Decow found interesting correlation, especially within very short intervals between cash flows, increases in cash flows, and share prices. And this is in this argument, in this sort of studies, the argument is that within short periods of time, cash flows are more important than accounting profits. Another group of studies that has been growing in importance, especially during this current period where companies are more focused on valuation, and the conceptual framework is more focusing on the balance sheet and the valuation of assets and liabilities on the balance sheet. There is a growing group of studies that has diverted away from looking at earnings and increases in share price, but instead look at asset values or asset valuations, for example, and whether it's has got correlation with changes in share prices. A lot of these studies are undertaken by people like Mary Barth from the United States, who is considered to be one of the experts in this area of valuation of assets on the balance sheet, especially for banks or financial institutions. So these sort of studies reflect the new approach in accounting, in the conceptual framework, and they attempted to look at the usefulness of valuations of assets, especially nowadays using fair value accounting. So this is an interesting group of studies that have shown some sort of value relevance to using fair value measurement in financial statements. And finally, this is the last slide, is that, I mean, the whole idea of capital market research is based on the assumption of market efficiency, especially on the semi-strong form hypothesis. But in a lot of markets, it is found that the semi-strong form market hypothesis may not prevail, may not be true. Okay, information may not impact into share prices immediately or within a very, very short period of time. There seems to be a lag. There seems to be a time difference between when the information is released and when the impact of the information is impounded into the share price. So there's a whole group of studies now looking at perhaps the market is not efficient. Perhaps there is a lag. Perhaps there is what we call earnings drift, that the impact to share prices might take a few months or a few weeks. So there's this, a relaxation of the efficient market hypothesis. So it could very well question whether some of these studies that have relied on the efficient market hypothesis may not be true. Right? So that's the lecture on capital market research. And if I can just sum up again, the key areas that you should take note of, and please remember, the capital market research topic or capital market research studies focuses on trying to find out whether accounting information at the end of the day is useful or not. But remember, the focus of capital market research is on shareholders, on the capital markets, so a very narrow perspective in terms of the definition of users. And it looks at aggregate information. So, you're looking at the reaction of the entire market. Okay, so you don't really know exactly what individual investors are thinking. You just know what the whole market is looking at. And what is important for you is to understand what are some of the assumptions, the major assumptions of capital market research. And the major assumption is the efficient market hypothesis, in particular the semi-strong form hypothesis. And to try and also understand the main study done in capital market research, which is the one undertaken by Ball and Brown back in 1968, and its findings. And finally, to go through some of these other studies and try and understand the key things that they found out with capital market research. In conclusion, capital market research have found some interesting connection between accounting earnings and share prices, but the results have not been that convincing, and I guess because there are also evidence to suggest that share prices are impacted by other information, not just accounting information. The impact of accounting information is only perhaps around 10-20%. So there's limited, the results are very limited in terms of its convincingness of the usefulness of accounting information. So that's it for this lecture on capital market research. The next video will cover behavioral accounting research. So I'll see you then.